Hello and welcome. This is Paul Pappas from Mortgage Choice. Hope you're all keeping well. Well, no doubt you know that interest rates are all heading north and increasing, and the short-term future for interest rates is probably not looking the best. We know that the Reserve Bank is on a policy of increasing interest rates, and the banks have been passing those rates on. So how does that affect you? What can you do about it? How can you beat the Reserve Bank interest rate rises? How can you beat the banks at their own game? So how do you beat the Reserve Bank rate rises? Well, what we've seen lately is this, and that is whilst the Reserve Bank has been increasing cash rates, lenders have been increasing their discounts on variable rate loans. So what I mean by that is this, and that'll just give you a couple of examples here. Now, so what we used to see was interest rates or discounts offered by the lenders of around 1.5 to 1.6%. Those discounts by some of these lenders that are chasing money quite aggressively and chasing loans quite aggressively are offering larger discounts. So what that could mean is that you could obtain a discount of an extra 40 basis points. Now that could represent quite a good saving for you, and that could be from your existing lender, it could be from another lender, it just depends. So why are banks doing this? Why are they offering you more discounts? Well, the reason is pretty simple, and that is that because of the slowdown in the lending market in general, banks are still keen to do two things. One, to retain their existing portfolio, but you've just got to be very careful about how you approach that and the method that you do that, and we know those tricks. But at the same time, they're also keen to chase for new business from other banks. So they're offering you not only cashback incentives of up to $4,000 and 300,000 frequent flyer points that can get you a return trip to London, but they're also offering you bigger discounts. And this is because of their aggressiveness to chase new business, but at the same time look after the back door and make sure that they're not losing it through the back door. So here's a couple of examples of what we've been able to achieve lately for a couple of our clients. This is in the last 2 or 3 weeks. So the first client had quite a sizable loan, actually, about $1.6 million, currently paying 2.84. Now bear in mind, this is an interest rate that they were paying before the most recent 0.5% increase. So we're able to get a 0.5% saving for them from their existing lender down to 2.34. Got to say, client was happy, but we also went back to them and said, hey, listen, we can actually get you down to 2.19 with another lender, which would then provide you a saving of around $14,500 or an overall saving of 0.65% off your variable rate. So that saving of $14,400 included a $14,400 cashback, an excellent saving. So that's over $1,000 a month back in the hands of our clients, all for being able to just beat the banks at their own game. So not only talking to their existing lender about sharpening that rate, but also looking at other alternatives as well. Our second client didn't have the same size of loan, but in this case they were paying 3.04%. We were able to get a reduced rate of 2.59, so again a saving of about 0.65%, which provided a saving of $6,000 to this particular client. Now in this particular case, the client was still happy with that, and decided to leave it at that. Now that's entirely up to yourself as to whether or not, as to how far you want to go. The point being here is that we can negotiate with your bank and with other banks to not only to provide additional savings to you, but at the same time look at all the other options for you, so we can beat the banks at their own game, so that you don't necessarily have to just sit back and watch these interest rates increasing and your repayments increase. We can try and manage this process for you as best possible to try and limit the impact for you as well. So where are rates now, and where are they in comparison to previous years? So this graph will show you exactly what we're looking at. So if we look at firstly these lines here, the yellow, the grey and the orange, they're the fixed rates for 2, 3 and 5 years. And you can see that these interest rates, as I indicated before, that these interest rates have actually been increasing since about October last year. And this has not been covered by the media at all, and I think we've mentioned that before in our previous updates. And they're at levels now, and you'll see a bit of an update as to exactly where these interest rates are, but they're getting up towards 5%. But more importantly, variable rates are only just starting to increase, and increase quite rapidly, as this line here shows, but we're still at levels that we saw back in beginning of the pandemic. back in 2020. So the point I also want to highlight here, a couple of points really, and that is exactly where rates are today. Fixed rates today are at quite high levels in terms of where they were historically. Variable rates, though, are still comparatively low in the overall scheme of things in terms of where we were, 5-10 years ago and so forth. But they are, the gap between fixed and variable is quite wide. So what's out there in terms of interest rates, and I've touched on this a little bit before, we're still seeing interest rates, variable rates around this 2.5% mark. In fact, I shouldn't say 2.5. They're really getting up around this 2.65, getting close to 3% in some cases, depending on your loan ratio, or LVR as it's called. But at the same time, the features you've got, whether you want a professional package styled, offset styled loan and so forth. But certainly they're getting, variable rates are now, say 2.64 to call it 3% or thereabouts. I'm not going to really go into a lot of detail on these fixed rates. To be honest, this is where the movement has been in the last 6 months or so. The gap between, as I indicated in that graph earlier, on the historical rates, the gap between fixed and variable is now quite wide, and very debatable as to whether this will catch up or not. Like I said before, some of our clients are looking at switching into fixed rate loans to give yourself some protection and so forth, but you really need to look at some of these rates and what they are at the moment. But certainly what we're seeing is that 2-year rates, 4.25%, 4.5% in some cases, 3-year rates getting very close to 5%, and in most cases they're close to 5%. The rate there, 4.64, is a very good rate from a particular lender, but they are getting close to that 5% mark. And the way the wholesale rates are going for these 2 and 3 year rates, you'd expect them to stay at these levels or continue at these levels for quite some time. 5-year rates, well and truly 5%, and in some cases greater than 5%. So the gap is very, very wide, and getting, in some cases, ugly, if I can use that word. What about investors? Now again, I'll just quickly go over these rates. Investment rates again are a little bit more than the home loan rates, but you're still seeing this same characteristic of a big gap between fixed and variable rates. And I do believe that the horse is bolted in terms of fixed rates, and you should only consider some of these fixed rates if you really want to give yourself some peace of mind in terms of knowing exactly what your repayment is, or if you do believe the interest rates are going to increase further than what these rates are on screen for you. So what should you do? Well, one thing we've been telling clients for a long time now, and that is do a budget at interest rates that are much higher than current levels. And for quite some time now, in fact quite a number of years, we've been strongly suggesting to our clients to do their budget at around 3.5% or even 4%. And many of our clients have been budgeting at those levels or even higher. And what that allows you to do is to take advantage of a redraw facility or an offset account to give yourself some buffers to protect yourself against interest rate rises. And if you can go further in terms of paying more off, we would always encourage you to do that. One thing that you definitely cannot afford to do, and that is to sit back and watch your repayment increase. In other words, please don't do nothing. You've got to do something. Talk to us about how we can take advantage of some interest rate discounts that are available. We talk to your lender, try and save some money for you. You'll be surprised in the way that we can do that for you, and definitely try and minimize some of this impact for you. So how high will rates go? Very interesting question that we've been asked a lot by a lot of our clients. And one thing we don't want you to do is to take out any type of bet with any of the sporting agents, as you'll know the exact issue. So let's just have a bit of a discussion about that. The Reserve Bank Governor and the Reserve Bank have been quite open about the fact that they would like to see, and they can see interest rates or their cash rate going to 2.5%. So let's put that into perspective. If the cash rate goes from its current level of 0.85% to 2.5%, and then the banks add their normal lending margins of 1.5%, 2%. So you've got a cash rate of 2.5%. You'll potentially see variable rates go to 4.5%. Is that sustainable? My thinking is absolutely not. And we believe that what the Reserve Bank is actually trying to do is to scare people to try and slow down and so forth. We don't actually believe that the cash rate will go to 2.5% or that variable rates could go to, in excess of 4%. We believe that interest rates, variable rates, would probably stay with the 3 on it and probably unlikely go above 4% in terms of the variable rates. And why do we say that? Because, like we said before, we believe the Reserve Bank is trying to get things to slow down and scare people into just slowing down and spending less money and borrowing less and taking some of the heat out of the property market as well. If interest rates were to go above 4%, variable rates to go above 4%, we have not seen those levels for 5 or 10 years. So it's something that, you know, when you add things to the other, when you add it to the cost of living in general, with groceries, petrol, and all these other pressures that we have, and wages not necessarily keeping up, interest rates above 4% is going to put a lot of volatility in the market. And what will then happen is that the Reserve Bank will have to slow down and, in fact, take rates the other way, go down. So the point of going up, you know, the Reserve Bank putting the cash rate up and then having to bring things back down again, is just creates way too much volatility in the market, something that we hopefully will not see. And we hope that the Reserve Bank does this in a more, in a flatter cycle, in a flatter way. So in terms of how you beat the banks at their own game and avoid some of these RBA rate rises, firstly, please allow us to review your current loan with your current lender. Let us do that talking, because we know how to talk to them and how to present it to them. And we will always be trying, and always have been successful in being able to get a better rate for you. Now, you might be happy with that, and that might be enough for you in terms of what the saving is and so forth. But we will also look at other options for you and provide those to you. And depending on the size of the discount that we're able to get from your current lender, as to whether it's attractive enough to stay with that lender or maybe consider other options. But we'll certainly do all that work for you and present them to you. And then let you make the decision as to which way you want to go. But please let us beat the banks for you. Let us try and save you some money in this environment, in this climate. Please do talk to us. Please get in touch with us. Use that QR code that's on your screen there to talk to either Ryan or myself. And please let us work with you, to let us help you beat some of these Reserve Bank increases. Let us work with you to try and beat the banks at their own game and try and save you some money on your own home loan. Thank you for tuning in, and we look forward to staying in touch.